Welcome to Money Matters with Matt and Rich, episode 12. We were going to have Mark Bashirs in talking about life insurance policies, whole life policies, but he is in the eye of the storm in Florida. So he's not going to be in today via Zoom. So wishing everybody down there well with this crazy storm that's coming through down there.
Right.
But we will have him back at some future point.
Yeah, he'll be on. He will be on.
To chat. And I was going to actually have a phone call with him at 3, and he canceled that too, obviously.
Right.
But he's wishing everybody down there well.
Yeah, absolutely. Obviously, it's, a little dangerous, a little scary situation, but
I think we've got a great alternative to that conversation.
Yep.
Again, going back on rates, we chatted about last week about, buying down points and essentially reducing what you're going to come out of pocket on your monthly payment.
Yep.
So what are rates right now that they've changed literally this week?
Yeah, this week has been a whirlwind, to put it lightly. I guess that's the proper way to say it.
Yeah.
The interest rates have gone from roughly 6.5, again, give or take, to about 7 to 7.5, depending on your situation, in about 3 days.
Yeah.
So
talk about a jump.
Yeah, it's a big jump. We haven't
Another one.
We haven't seen this jump since when we saw like the 4.5 to 5.5 back in like June maybe or May.
Yeah.
There was it happened in a full day. It was like people were qualifying for a house. They got under contract. By the time we submitted the loan, they did not qualify.
Yeah.
Because it happened that quickly. This one wasn't that fast, but it was still ridiculously fast. Right, we're talking 3 days. It goes up about 0.75 of a point, and it's really, it's impacting people's buying power. But like last week, we talked about buying down the interest rate. Right, we got another option that we can chat about today. But just so everyone's aware, right, the news is about a week behind. So when you hear that rates are about 6.25, like I heard on, I think it was like Good Morning America or something, that's not the case anymore. That was last week. That was legitimately last week.
Yeah.
It's not the case anymore. We're at about 7 to 7.5 on your mortgage,
and that's nationally.
Yeah.
This isn't just like, hey, it's just me. Just local. Like that's nationally.
That's national. Everyone's there.
And it's not like, so the biggest, weirdest thing of this whole year is not that the rates have adjusted or changed. It's that their rate of change.
Correct.
That they've gone from
Right.
sub 4 in January to over 7.
Right.
Would 7 normally, and if we had adjusted there over time, be a big deal? No, but like the drastic rate of change and the still the supply and demand issue that's out there.
Yep.
It definitely affects people.
I think that may be the reason consumers are a little frustrated or a little frazzled is the intensity in which they are doing it.
Yeah.
Like you said, if you go from 4 to 7 over, 2 years, what would that be, 30 months, 24 to 30 months, it's like, okay, it's annoying, but consumers can gradually get used to this, right? When you do these massive jumps in 3 days, 1 day, 5 days, it's like you have a hard time adjusting to anything in their life. People don't like change.
They go from approved to not approved.
Not approved.
Like in the matter of 7 days.
Right.
So if they got in touch with you last week or a week and a half ago, and you're like, oh yeah, you're approved. Here we go. Here's the rate. They might be not approved, and now their home ownership dreams are gone.
Oh, gone for now.
Like
anyway,
just because of the government, the federal government.
Right. Yeah, it's crazy.
Not because of anything they did.
Right. Yeah, it's pretty wild when, like you said, when you got to adjust pre-approvals. We've done this twice already this year, but it's still like 40 grand, 50 grand, 60 grand on pre-approvals. And it's like, holy crap. And just the house difference you get with that amount of money, and you're paying the same amount that you were before, like in terms, like the payment doesn't change. You qualify for the same payment, but the house you get with that payment now is a lot different. You may be in a different town. You might be, maybe you're looking at 4 bedrooms. Now you're looking at 3. Maybe you're looking at 3 bedrooms. Now you're at 2.
Yeah.
Like it can drastically change the house.
That buyer didn't even get a chance to start looking at homes.
Correct.
Right. Nevertheless, put offers in if it's only been, less than a month.
Right. But, I should put the caveat out there. It sounds scary, but all this means is that there's going to be less competition out there for buyers. So, and
there'll be other new products to help these
buyers
to be strategic and have a plan to get into something.
Right. So I really emphasize, you should not steer away from buying a house right now.
No.
If you can afford the house comfortably, right? go buy the house that you want.
Yeah.
Right? Don't, because the rates this crazy. Rates fluctuate all the time.
Yep.
If you think you're going to be in the same rate for the 30 years of that mortgage, you're crazy. It's not going to happen.
First time buyers look for and want that forever home.
Right. Right.
They're a first time buyer for a reason. They're called that for a reason because their first home is a 3-5. Nationally, it was always 7 years, and then the buyers are out. But it's been sort of more like 5 years. So 5 years are gone into the next house.
Right.
First time buyer is just that, a first time buyer. They are a second time, and very likely they're also a third time buyer.
Yeah.
And then they've got that final home. But they've used that first home. It might not be your perfect home, but it might be a very good home. To get in, use that first home to get into the second home, to get into the third home. It's compounding to help you get to where you want to be.
Right. Right. And that's exactly it. Hopefully you make more money. Hopefully your debt situation, your consumer debt situation comes down so that you can afford more of a house. Right. That's the whole thing.
And the equity that's built in that house while you live there for 5 years and you've paid the mortgage down.
Right.
Now you use that equity to get a bigger down payment into the second one.
Yeah. Right.
It's a great,
and then a bigger down payment to get to the third one, right? So your mortgage payment may not actually move, right? It may it may change by a couple $100, but when you think about the house that you're getting,
bigger house,
you would never be able to do that for your first house if you're putting 3%, 5% down, right? Like the payment's going to be astronomical. Like it's almost not worth it, no matter really what you're making. Like have like a $6,000 mortgage. It's like, oh god. Yeah. But yeah, so there's a new option out.
What's it called?
It's called a temporary buy down.
Temporary buy down. Okay.
So we have two options. Generally speaking, there's only two options. So it's called a 2-to-1 buy down or a 1-to-0 buy down. That may not mean much right now, but we will explain what that means.
Okay.
So I have two examples. There is going to be a lot of math here. But for a $300,000 loan, we'll start there. Because again, that's kind of like your typical, like Manchester now really is, that's kind of where you're typically falling around.
Entry level, first time.
So I did a par rate of 7.25.
7
that's
and
about
a
where we're at. 7.25. I made it as realistic as possible.
Yep.
The principal and interest payment on that property, and mortgage insurance too, I realize that now. Mortgage insurance as well, would be $2,046. Okay, with the 2-to-1 buy down, what it is for the first year of your mortgage, you get to have an interest rate of 2% lower.
2%.
So not 2 points.
2 points.
2%, which equates to a 5.25 mortgage.
Hey, fantastic.
Way better than 7.25.
Yeah.
Obviously.
Love that.
So that principal, interest, and mortgage insurance payment is $1,656.
So you're taking about 400.
Yeah, it's about $390 difference.
Yeah.
It's a very drastic difference
Over
in
12
house.
months.
Over 12 months. And then, so that's the two part of it. So after the first year, your rate goes down 1% from your original par rate. So in the second year of home ownership, you will have a rate of 6.25%.
Yeah.
Okay, that payment comes out to $1,847, which is pretty much $200. $199.
Yeah.
It's $200. If you look at the savings, right?
12 months.
Right, exactly. If you look at the savings over that 2 years, you would save $7,056 over those
2 year periods. Yeah.
Okay.
And
now,
you could save that. You could, save it for when the rate goes to the 7.25.
Yep.
You could invest it.
Yep.
And
put it in an emergency fund.
Yep,
put
emergency
it to buy other property. Like,
Yep.
You do whatever. Obviously, you can do whatever you want with the house
Yep.
or with the savings. So I get the next question we always get now that we've been telling people about it is, well, do I have to pay that $7,000? Because that obviously makes a difference. You don't. Okay. Well, you'll get what I mean. It's like you do, but you don't.
The savings, the 7,000 savings.
Correct. So what happens is you ask for a seller credit that we talked about in the last episode, episode 11 of Money Matters.
Yeah.
So what you would do is you would ask for a call it a $7,100 seller credit at closing, and where that money goes is it goes into a separate escrow account, which is a fancy term for just a third party account.
Yep.
And the lender draws from that account every single month to make up that difference. Okay, so you're not paying that difference, right? There's no like caveat to this. There's no like, oh, we're gonna get you on the back end, right? It's nothing like that. It's held in an escrow account, that seller credit, and then that gets drawn in. So the lender or whoever buys the loan is getting that same money every single month.
Yep.
Right. So that's the there's a safety net to that.
And it's potentially that the seller could pay for it. You'd want to try and ask them for it because that's really where it makes the most sense.
Yep.
And from my perspective, it's like, okay, maybe not every home that's listed for $300,000 is also going to want to give you a $7,000 credit.
Right.
They are out there, and identifying the right ones that will do that, I can help you with.
Right.
Another strategy would be to just increase your, in my eyes, would be to increase your offer price.
Yep.
By the $7,100. So we're giving them $3,701 and asking for the $7,100 credit back.
Right. So they're netting the same number that they're asking for.
Which is the most common practice, 2018 and forward.
Yeah.
Like we would always do that. Just increase it by 10 grand and ask for 10 grand back.
Yep.
Doesn't do a heck of a lot to your monthly payment.
Correct.
Realistically, it doesn't.
Right.
So yeah.
Right.
That'd be probably two ways to access that and get that $7,100 from my perspective.
Correct. And now, if you look at maybe that second home that we were talking about, like, you're moving up in house, you're somebody right now that, okay, you're selling your first house or, you're looking to upgrade.
Yep.
So now you have a $500,000 loan.
Perfect spot.
Okay,
500 is your next home. That's the second home.
That's a second home.
That's your
typically
second home buyer.
Your savings, I won't go through all that math. It's the same thing. 7.25% to 5.25%. Up to 6.25%, all the same interest rates to obviously keep it even.
Yep.
Your savings over the 2 years would be $11,785. Like, you're averaging almost $500 a month in savings.
Yeah.
Like that you hypothetically don't have to pay for.
Right.
Like you didn't have to pay for that.
Yeah.
Again, it's in an escrow account held by the seller, or paid for by the seller, not held by the seller. So to me, it's almost a no-brainer. But now you might ask, okay, why would I do this instead of buying down points? Like what's the difference? And I did that out to kind of show. So really, it's looking like about 2 points or 2% for a seller concession that you need, give or take, right there. So I said, okay, if you buy down 2 points on the interest rate, so you still ask for the seller credit, but you use it to buy down the interest rate.
Yeah. So 7.25% down to 6.75%.
Yeah, it was somewhere in there. It was like 6.3, 6.4, depending on each situation there.
Sure.
So for a $300,000 loan for that first example, you would save in the 2 years about $3,500.
Yeah.
Versus $7,000.
Mm-hmm.
In the $500,000, you would save $6,000 instead of about $11,700. To me, that's a no-brainer.
Yeah.
To me, it's
Cutting
a no-brainer.
In half, yeah.
And with the buy down, we see a lot that people almost feel obligated to get their money back, right? So if your break-even point's 36 months, 40 months, whatever that break-even number is, people feel obligated to stay in that loan until then. Mm-hmm. With the temporary buy down, you can refinance whenever you want.
Yeah.
And
so say interest rates go from 7.25% today. 3 weeks from now, they're at 5.5%.
Right.
Oh, well, maybe you can lock into a 30-year loan at 5.5%, which is what I'm at right now. And I like, actually, it's higher than I'm at right now.
But the payment isn't going to drastically change at that number.
Yep, and you're comfortable with that.
Right.
And that, that timeline of that happening is probably not realistic, but the 7.25% to 5.5% at some point in the future
is likely.
Is likely.
It really is.
What that future looks like in that length, I don't know.
Right. But we will be there. We will be back there. So then the question would be, when you refinance, or if you refinance, I should say, where does that escrow money go? Right? Do I just lose that? No, you don't just lose that. So let's say, again, to keep the number very simple, let's say, the $500,000 loan, let's say you still have a $500,000 balance on it. And in, 2 months, the rates drop to 5.5 and you're like, psh, I'm refinancing.
Yep.
And you have $10,000 left in that escrow account. When we order your payoff, so when we pay off that loan to refinance you, because that's what's ending up happening, we take that $10,000 and put it all towards your principal. So now your loan, your payoff is actually $490,000. Yeah. So it's going right towards essentially making up for that seller credit that you asked for. So you're not
Nice.
stuck anywhere. You're not stuck in anything. To me, it's like a no-brainer. Again, pending you get the house in the seller that will actually do that for you.
Exactly. And I think there's a lot of uses for that, savings too over, monthly, every month. If you can, $500, you can use that to either, upgrade the property to make it nicer, to, increase the value of the property, come refinance time if you do, or come the time that, the rate is great.
Right.
Because $12,000 over a 2-year period, you could do some upgrades.
Not bad.
And, you can, manage the property, buy a lawnmower and do all that stuff that maybe if it were, not that great at 7.25, you can still do.
Right. Right.
And not that we want anyone to be house poor.
Right.
But
not at all.
at least it frees up
that money.
A little bit of money and maybe some stress.
Right. I mean, think about the person getting the $300,000 loan right now. Like, you're telling me they wouldn't want an extra $400 a month in their pocket?
Yeah.
With how everything's going right now? Like, that would be very freeing to people. You don't have to stress about your groceries.
Yep.
Like, you're probably already stressed enough about buying the house right now because you want the house, and maybe it's your first home. Your debt to income's probably not like 20. It's probably up towards the top of the qualification, just simply because of your income and your debt situation.
Yep.
So if you can save $400 a month to ease into home ownership, and then we have a buffer, and then we're still saving $200 a month next year. Right, it's like okay.
So and that's another great point I didn't even think of. Because of inflation and cost of everything, groceries, gas, it makes that a lot less stressful too.
Correct.
If you can take some of that out of the equation with this program,
correct.
Hey, okay, great. I got the $400 for a year. Like, hopefully everything will come down in a year. If it doesn't, at least the following year, I'm still saving, a couple $100 a month.
Yep.
And hopefully by the end of year 2, we're not in this inflationary market where gas is expensive, groceries are expensive,
everything, freaking electricity,
electricity,
like everything.
That does help ownership.
It just adds to it. And don't take this is not financial advice, but don't take the $400, please, and go buy like some stupid jet ski or
Xbox.
car. Yeah, it's like something crazy like that. Please actually utilize it. We don't want you to then have that payment raise on you. You forget that it was like, oh wait, I'm still supposed to be saving money, and then you're strapped even more. Please make smart financial decisions.
That's the toughest part. And I suffer with it too. Right, like the rich dad, poor dad. Buy assets, not liabilities. So take that extra money that you're being granted and do something good with that, right?
Right.
Upgrade your property, or even if you just stuck it in a brokerage account or, buying stocks while they're on sale and let it grow from there.
Right. Just do something productive.
Right. And again, not financial advice. I'm not a stock trader. I don't know any of that stuff.
Right.
But there are options out there and can certainly connect you with the right people to talk to on that stuff. But, $400 a month. You're funding an IRA,
right?
A traditional IRA,
right?
Like, that's fantastic,
right? And even saving cash isn't obviously the growth wise isn't the best thing, but again, a first time home buyer could have an $7,000 buffer by the time now that payment goes to what they were already comfortable with going.
Yeah.
Okay, now it's we have 3.5 months of mortgage payments saved if we both somehow lose our job.
Good reserves.
It's just more freeing. You're okay, we're gonna be okay.
I think another important thing to maybe hit on again is that, in fact, the buyer is approved for that. Our interest rate.
That's a good call. Yes.
7.25.
Yep.
They're still approved for that interest rate.
Correct.
There's no issue there.
Right.
This is a stress reliever, a perk, call it what you want.
Right.
To reduce those monthly payments for the first 2 years.
Right. And that's a really good point that I really should have touched on is we qualify you in that example at the 7.25.
Yep.
So you have to still be able to qualify for the loan at that highest payment. It's not like an ARM where we qualify you on today's rates, or if you do a 7 or a 10-year ARM, we qualify you on today's rates, and then hopefully you can afford it if
in year 6 or 8 or
7, 11, whatever that number is. Hopefully you can afford that. No. That's that, and then it's fixed. Then you're fixed at 7.25 for as long as you want it.
Yep.
Right. So it's not an ARM per se, because it's not adjusting randomly or every quarter, right after you already close on the loan or after there's a set period there. You're buying down that rate. Right. And the lender's still making their money. They can still sell the loan. People don't want to think about this, but they sell the loan to the government.
All the time.
They can still sell the loan to the government at 7.25%
because they know they're still making their money.
Because they're making their money, right? So there's no catch. There's no there's no oh, we're gonna get you somewhere. There's literally nothing. Everyone's still making the same money. So there's nothing to be skeeved out about, I guess. There's no.
Well, it's just different, right? Because in this market with this drastic change, there's a lot of lenders that are getting creative and a lot of banks that are getting creative on what they're, I don't want to say pushing, but the programs that they're advertising. It's like, hey, over the last 2 years, don't forget, we offer, HELOCs, we offer, lines of credit for this, that, and the other thing.
Yeah.
Primary, and maybe we do a different plan. We've had to adjust since the rates are different now.
Right. Right.
Maybe we do an interest only. Maybe we do a different rate, locked in for a year or 2 years.
Yep.
Yeah. So not unlike that. This is what that's doing. It's just, hey, let's get a little bit more creative.
In how we do it,
and how we do it,
and it's safer too because it's all very clearly written out to you.
You can plan for it.
You can plan for it. The rate doesn't go higher than the par at the fixed rate that you qualified for. Everything is all right there.
You can refinance with no penalty.
You can refinance with no penalty. You can. There's no prepayment on it. Even if you win the lottery in 6-7 months, cool, paid off.
Get a promotion.
Go get it.
And God forbid, if you have to move or you have a life circumstance change,
you're still fine.
You're fine.
You don't lose that money. There's no so it's
safe.
It's to me it's a really good program. And I guess the last thing too is you can use it only on purchases. So you can't refinance and buy it.
Refinance into that.
Right, so you can't refi into this, but with purchases, you can use it for a second home. You can use it for investment properties if you so wish to, again, ease your way into that. Maybe it's your first investment house and you're a little stressed about, there's not enough cash flow for you that you were very comfortable with. Taxes come back higher or something like that. It's like, okay, I still have this buffer to where I can create the reserves in that 2 year. And now in 2 years, you have reserves.
And in that scenario, for an investment property, definitely use that to stockpile your reserves.
Correct.
And for your capital expenses, do not touch that money. Mm-hmm. Let it be what builds that account.
Right.
And actually makes it a little bit, more freeing and comfortable.
Yeah.
Because it's like, great, I've got now this stocked away that I didn't even have to pay for.
Right.
$7,000 or $10,000 or whatever that ends up being.
Exactly.
Based upon the price point of the home.
Exactly. So, God forbid you need a new furnace in year 2. Okay, cool. I got $7,000 saved.
Yeah, that should help.
Again, it's annoying, but it's not a life changing thing now that you gotta account for.
What about 40-year loans?
40-year we don't offer quite yet. We do have interest only for 10 and then amortizing for 30. So I guess that's technically a 40.
But it's a 30-year loan?
But it's a 30-year loan technically.
So 30-year loan, the first 10 years are interest only.
Correct.
Then for the last 20, it's amortized over 30, but you still have 20 years on the loan.
I believe it's still amortized over 20. So it's a 30.
It's amortized over 20.
It's amortized over the 20.
Yeah.
But we don't have any 40-year mortgaged. Honestly, I want to say yet because we're probably going to get some.
They're out there.
We're going to get some lender that we work with that introduces that out there.
Yeah, they're out there. So a 40-year loan is 10 years interest only, so nothing towards your principal.
Yep.
And then the last 30, it's principal and interest, again, amortized over the 30 years.
Right, right. Yeah. I mean, they're coming. That's for damn sure.
They
are definitely coming.
There's some lenders out there that do them. Again, you can save $200, $300 a month in principal payment.
Right. It's just tricky.
Depends on what your goals are.
Yeah.
I'll just leave it at that. It depends on what your plans are.
Yeah.
You got to have definitely a plan in place.
Yeah, you don't want to just do that to just get into the house and that's just, I don't know.
50-year loans.
50. Oh my god.
100-year loans.
I can't even fathom if
I was listening to a podcast the other day, and they've got life, is it estate or generational loans? It's for the life of the generation that owns this property.
Oh my god!
It's just always a loan.
Right. That's horrifying.
As long as they're alive, there's a loan out there.
Right.
We'll span it out as long as you want.
That's wild. Like
Different country, different
Oh, I'm sure.
different ideas. But
Right, right. Yeah, no, like I'm sure we'll start seeing crazy stuff on it. Not to scare people, but probably like we saw back in 06, 07, where lenders are just getting desperate for business, right? You won't see it from the big names.
Yep.
You'll see it from the people that are out on the news that are closing at, at moment's notice, and they're saying we're no longer funding loans.
Yeah.
You shouldn't be getting a loan through them anyway.
No.
And again, it's not big names. We're not talking about the names that are banks, retail lender, wholesale lenders that everyone knows of.
because they've already gone through that.
But
They don't want to do that again.
These businesses have the money and the capital to withstand it, right? So we're not talking about those, but I mean, it wouldn't shock me if we see 6-month bank statements or even 1-month bank statement just to a plea to get business in from people. And then please don't, we will not sell that. I'm not saying I'm going to sell that. I'm not saying PML is going to sell that, but it wouldn't shock me if you start hearing crazy stuff like that again.
Well, because this is real estate's slow to react to what's going on in the market. So now that we're at 7.25, it could take 6 months to see the effects from that.
Yeah. I think we're just seeing the effects from the fives, where things are slowly coming down now.
Right.
So I agree. I think we're a quarter or 2 quarters kind of behind on everything.
Yep. Just like in 2008 and 2009 when the market crashed. Well, the deals didn't happen until 2010, 2011.
Right.
Years later. So 2008, they happened in 2010. 2009, they happened in 2011.
Right.
That's where the deals came onto the market.
Right.
Or were out there. The people were buying, at very low prices.
Yeah, I was going to say very little to nothing for the house.
So, it's always slow to react. I think, what was I seeing? A 6-month arm?
Oh, boy.
6-month arm? Holy moly.
Yeah.
Jeez,
Yeah.
You got to have a real set strategy if you're going into that.
And I was going to say, but you're just kind of betting on the fact that you think this is all going to slow down in 6 months and then it's going to come down and then you're just refi at that point. That's kind of what you're betting on.
Yeah. Or you've got you're going to turn so the other thought I had on that one was okay, you're going to turn the property from a $200,000 property to a $400,000 property.
Right.
Because then you can refi and,
Right.
and reduce your payment because you have such a low,
LTV.
yeah, exactly. So then you can get at least a reasonable, monthly payment.
Right.
But 6 months, we're still going to be, we're going to be in the 8s at that point.
We are going to be in the 8s at that point.
Yeah.
We're going to see 8s over this winter and then everyone's going to freak out.
Winter is coming.
Yeah. Yeah. We had a couple guys go to an event in Mass with one of the attorneys that we work with, and there was the BOA, a top economist there, and he said 6 to 9.
Yeah.
So it's probably going to be 9 to 12.
Because we've already passed.
Being realistic, it's probably going to be 9 to 12. But again, it's not a bad time to. It literally is never a bad time to buy real estate.
Just get the house.
Just get that.
With the rate that gets you the monthly payment you're comfortable with.
Mm-hmm.
Get into it. Mm-hmm. Start building your wealth and your nest egg for the second home or for the refinance when that time comes.
Right.
It doesn't matter if they're 15%, 50%.
Right.
Just get. As long as the monthly payment makes sense.
Yeah.
You're going to have to look at maybe lesser of a home, but that's okay.
Mm-hmm.
We can't have all champagne dreams and caviar dreams and champagne
for a first
home. If you're renting right now, get out.
Right.
Just get out.
Right.
And there's going to be opportunities to get a decent home without competition.
Right. Well, here's my argument to renters now, too, is rates are increasing. Investment property, multifamilies have not come down yet. What do you think is going to happen to the rents in that house when the investment guy buys it at 8%? What do you think is going to happen to your rent?
Goes up.
The renting market is going to have to follow this. It has to.
Even if the house doesn't change hands at a new higher interest rate, electricity's going up.
Right.
All the bills are going up. Heating oil's all that's going up.
Right.
That gets passed down. Mm-hmm. So regardless of that, the natural thing is when home prices go up, rents go up. Inflation goes up, rents go up.
Right.
And home prices also go up.
Right.
They're not going to go up 25% like they did last year, but they're still going to go up.
Right. And it's funny, too, because, just for my perspective, right, on, just my house, everyone says I bought at the worst time because I bought in May and closed in June. So right before all this craziness happened.
Yeah.
But I always laugh because our intent and, Michelle and I's intent on all of this is we're probably never going to sell the house that we're in. Mm-hmm. We will never, ever do it because we will just, even if we move out, we will just rent this house out because this is essentially our retirement at this point. It's part of our retirement portfolio.
Yep.
Like, it would make zero sense, especially if there's always now going to be this supply and demand shortage because of all these companies coming in and buying houses. The house prices are going to naturally keep going up, probably at a faster pace because there's less of them out there that are owned by physical individuals. Yeah. Why would I not keep this house and just have it appreciate?
And if you look at like the paper from the 80s for house sales, because that's where they were posted back then, they're in a paper. Like, if you still had one of those houses, they're selling for 80 grand, 90 grand.
Yeah.
Things worth 600, 700 now.
Right.
Like, that's just the way it goes. Believe it or not.
Right.
Yes, there are like kind of ups and downs.
Yeah.
But the long-term hold, primary residence, investment property, secondary home, whatever it is up.
Right.
It's an upward trajectory.
Right. And people think it can't withstand, right? But think about like 7 years ago, what $100 grand a year in income meant versus now what $100 grand in income is.
Yeah.
Right. It's just it's unfortunately the natural progression of this, right? You got to keep with the times and keep upping everything, right? Or you're just going to get swept off by inflation. Yeah. So it's like it is going to happen. It sounds crazy that a starter home in 30 years might be $1 million to $1.5 million. It sounds crazy, but when people are coming out of college making 100 to 150, and they
as a baseline,
it's not gonna. They're bringing in $13,000, $15,000 a month. Like, it's not that wild of a circumstance to think of.
Yeah. And of course, that's, not, again, every market's going to be different, right? Like, California is going to be different than New Hampshire. It's going to be different than Arkansas, the Midwest. But yeah, generally things go up. I mean, starter homes were 80 grand before.
Yeah.
Now they're 350 to 400.
Right. And that's in 40 years. So if you hold your house for 40 years, like at that percentage, you're literally talking about a $1.5 to $2 million house in 40 years.
The problem we're going to see over the next 6 to 8 years is everybody's like some statistic like 70% of homes are 4% or less interest rates. Why would they sell?
Right.
Unless there's a life circumstance that changes their position.
Yep.
But even if there's another kid, guess what? We're getting bunk beds. Yeah. Not getting another bedroom. I'm not paying another $1,000 a month in mortgage for a bedroom.
Right.
You're getting bunk beds.
You're getting bunk beds, and you're going to get comfortable with each other.
You're going to go back to like it was, like when our parents grew up. Yeah. Like there was 5 kids in a household, and we had 3 bedrooms.
Right.
Like what? That's crazy. Why isn't there 1 bedroom per kid?
Right. Yeah. Well, people get spoiled.
Yeah, exactly.
It's not the
norm. No. So it's
crazy.
For $1,000 a month, am I going to get a bedroom or not?
Right.
Bunk beds.
Yeah, bunk beds for sure.
So yeah, there's going to be a lack of supply just from the sheer fact that everyone's got sub 4 interest rates.
Mm-hmm. It's going to be tricky to move out of that one. That's for sure.
Doesn't make sense.
No, it doesn't.
Make sense.
But no, that's all I had on temporary buy down. You got anything else?
Awesome. No. I think we've got a guest next week.
Yes.
Definitely investor focused. Matt, the lumberjack landlord, is an investor out in the upper seacoast, like the Dover area.
Yep.
And he's going to come in or not come in, but Zoom or at least over the phone to talk about 4321 and reverse offer strategy. The 4321, I wish I understood it better in like my 20s.
Yeah.
You buy the 4 family, rent that out for a year, 2 years, 3 years, and you buy the 3 family, live in it, rent it out, buy the 2, and you're keeping the 4 unit, renting out the 3, then you're keeping the 3 unit, you're getting into a duplex, and then you use all of those properties and the equity and the cash flow and your life situation to buy your single family forever home.
Right.
Oh my God, it would have saved me a lot of time. If I started that in the 20s and in my late 30s, I would have figured it out. But so yeah, cool strategy. He's going to chat with us about. Definitely a lot more investor focused. So if that's your bag and you want to talk with or hear from another New Hampshire guy in in this market, definitely tune in next week.
Yes, same time. I think 11:30 or
11:30.
Yeah, 11:30 next week. Stay tuned. There's going to be a lot of great info on that. I know I'm going to learn a ton on that, so I'm sure a lot of you out there will as well.
Yeah.
So
even if you're not thinking of it now, it's good. Just
good knowledge.
Good knowledge, and like I said, I like the multifamily strategy. Wish I had done it sooner to get into a single family. Because again, your first time buyer, it's not your forever home.
Right.
So might as well make that an income producing property.
Right. Yeah, exactly. Exactly. It's a no brainer. But stay tuned next week. It'll be episode 13. And that is why money matters.